So an opening range gap, obviously, I see a lot of students with confusion. They're thinking that the new day opening gap is the opening range gap, and hopefully we'll clear that up for them today. First and foremost, you have to check to make sure that your chart is showing in the regular trading hours, not electronic trading hours. You find that in the lower right hand corner. Usually you'll see RTH or ETH right here, and it has to be toggled to regular trading hours. And the time zone has to be set to New York, always. All right, so we're going to be looking at this candlestick right here on a 1 minute chart. That's the time frame that's being shown here. So this candlestick, if you take a look at this candlestick's closing price, you can see it up here, 21,049.75. And I'm highlighting it here so we can see that the candlestick is basically small little bodiless candle. And I didn't want to hide that by having that little annotation covering it up. So that's your first point of interest, which is previous day's regular trading hour settlement price. That's always going to be, as you can see here, at the 4:14 p.m. Eastern time on a 1 minute candlestick. Here we can see at 9:30 a.m. on the very next day, regular trading hours is going to only show the difference between where we settled the previous day at 4:14 p.m. to now the first opening price at 9:30 Eastern time. Again, all New York local time. So this here shows that we're opening higher than where we settled in regular trading hours, the previous trading day. 9:30 a.m. Eastern time, higher opening price in regular trading hours is classified as a premium opening range gap. The opening range gap is 120 handles or larger. Price could leave the gap unfilled. When you have a premium opening range gap, what you're doing is you're going to take your Fibonacci, and this is the fib settings. That way you guys can have it real quick reference point. You're going to take the fib and anchor it to the previous settlement price at regular trading hours at 4:14 on a 1 minute chart. You're going to drag the Fibonacci up to the opening price the next trading day at 9:30 Eastern time. And again, your chart should be toggled to regular trading hours. It should look like this in the lower right hand corner when you're on that 1 minute chart. These are the settings that have to be toggled. And if your numbers don't look like this, all you have to do is just double tap inside of every individual gray box and type in what you see mine is showing here. Now, obviously, when you have a large gap like this, which is a couple hundred handles between the previous day's regular trading hour settlement at 4:14 p.m. to the opening price at 9:30 Eastern time the following day, with such a large gap like that, the rules I employ is that it's probably going to keep going in the direction of an extreme gap like that. And if it ever, it may not even do this much, but if it ever does trade below that low, usually it's going to stop around the upper quadrant. And you can see that here. Okay, so 25% of the opening range gap is usually what you'll see traded there. And I actually gave you this earlier in the week with the lecture. The very first lecture outlined it, and then I traded with that same logic that evening going into the midnight opening range, which allowed me to segue into that smart money concept. When there's a large gap like this, okay, 120 handles is a good ballpark number where it could potentially keep the gap unfilled, meaning that it doesn't come all the way back down to the previous day's settlement price. But it will eventually, at a later time, do that very thing. Now, if you are seeing the market trade higher as we go into an economic report on the calendar, this could usually be kind of like pumping the market up higher. And then at a later time in the same week, or the very next day, it can trade down into that level here and maybe go into the middle of the gap, which is consequent encroachment. This is that 50% level here. Eventually, price will want to rebalance all of this here because it's inefficient, because there's no price at all, zero. So this is an actual liquidity void. It's not a buy sign, imbalance, sell sign, inefficiency. It's an actual liquidity void. It's an actual void because there's no trading, buying or selling between the price of this closing price and where we opened at 9:30 using regular trading hours. Now, obviously, when we start trading at 6 p.m., unless this is a Friday, which it's not because you can see it says Monday, at Monday Eastern time at 6 p.m., the market will open up. And then whatever it does between then and 9:30, that's shown in electronic hours. We don't need to see that here because the opening range gap is defined by regular trading hours only. As soon as you start showing electronic trading hours, what you're looking at there is new day opening gaps and or new week opening gaps. So just make sure you know in your notes, if you're looking at your time reference in the lower right hand corner, regular trading hours is always going to denote what the opening range gap is going to be, if there is a gap. If it's showing electronic trading hours, ETH, then it's going to give you the information that we derive for new day opening gaps and or new week opening gaps. Okay. Obviously, when the market shows a lower gap opening using the same parameters at 4:14 p.m. and we open down 9:30 Eastern time the following day, again using the regular trading hours, this lower gap opening, when we have that at 9:30 Eastern, if that lower opening price in regular trading hours is appearing, then that is classified as a discount opening range gap. If it's this large, again, we have several hundred handles, the 25% of the opening range gap or lower quadrant here, that would be your target, if at all. It may not even trade back to the high or even go back into the opening range gap. So we would use the rules as I outlined when it was a premium open gap. So let's take us back to that premium opening gap. And I want you to think about how when we're looking at a lower gap opening, we would be drawing the Fibonacci down, whereas at premium opening gap, we're drawing it up. So it gives you the proper classification for the quadrants. Upper quadrant here would be a quarter of the opening range gap. If we are trading anywhere between 20 and 75 handles with an opening range gap, whether it be premium or a discount gap, and again, the classification is only determined by if it gaps higher at 9:30, that's a premium. It's a gap higher. If it gaps lower at 9:30 than where we settled at 4:14, that's a discount opening range gap. Okay, and the only reason that's important is it helps you determine what direction you're going to draw the fib on. So premium opening range gaps are drawn from the previous day's 4:14 p.m. Eastern Time's settlement price up to 9:30 opening next day. Again, toggled on regular trading hours, and reverse it for discount opening range gaps. But if it's 20 to 75 handles, usually if it's a premium opening range gap like this, what I like to look at with electronic trading hours, okay, so this is for your notes, you gotta write this stuff down, I'm not gonna do everything for you. If it opens higher, I like to see it trade to a pre-market session. That means anywhere between 6 o'clock in the morning Eastern Time to 9:30. All that time there is pre-market. So if we have a premium opening range gap like this at 9:30, I want to see it trade to some overnight London high or relative equal highs, or some high that was formed between 6 o'clock in the morning Eastern Time to 9:30's opening price. So it's going to run buy side initially. And then I would look for it to trade back down into minimum consequent encroachment, which is the red level here, or middle of the gap. And depending upon how I'm bullish or bearish, or if I'm just trading inside of a range, will determine whether or not I'm going to look for a complete gap closure. And there's a lot more rules we'll talk about before we get to the end of this month, and I'll have all those details for you. But we're just giving you very specific rules that I'm going to be employing for the majority of the times when I'm using opening range gaps in 2025 with this model I'm giving you in detail. Everything I'm saying for when it's a premium gap, you're just going to reverse the logic for a discount opening range gap. But here you can see it's the very next day here where that gap higher, that premium opening range gap, it trades up and it eventually comes back down intraday to that 3 o'clock in the afternoon, trades down into that upper quadrant. So you can see how it was not willing to come all the way back down and close in that gap, which would be a perfect delivery to that price. It's not happening here. But it does trade to the upper quadrant of that gap. Now, why is it called the upper quadrant? Because the gap starts here at the previous day at 4:14 Eastern time and opens here. So since it's an up gap or premium gap, think about this as the range. Well, this is the upper portion of that gap. This is the middle of that gap. This is the lower quadrant of that gap, and this is the low of that gap. So when it's an extremely large gap opening, my interest is only at this upper quadrant. And then I'll see if it wants to have any interest in going back down into the middle of the gap. But 20 to 75 handles, I like the odds of it trading to mid gap. Now there's a sweet spot between 75 and 120 handles where it can go either direction. So I usually err on the side of what do I see in other analysis concepts that is going to help me, because I may have to just sit on my hands and wait till 10 o'clock and not trade anything at the opening range, which is the first 30 minutes of trading between 9:30 Eastern time to 10 o'clock. So when I have 75 handles to 120 handles or less than 100 handles or so, these are just general rules where I have to lean on what the market has in price, where we are with the economic calendar, and where are we at with seasonal tendencies, the current market structure. All these things have to be referred to when the range is higher than 75 handles. All right, and then obviously the very next day, entirely new trading day, we have another gap here. Now this is the opening range gap, which is very, very small here. But it opens, trades down, comes right back up into it here, and then we break lower. All these lines here are derived from the previous 24-hour session where that opening range gap formed. So that premium opening range gap, that's what these levels are here. So this is the high of that previous opening range gap, the upper quadrant that I said that it would trade down to. You can see it when it did here. And then we just consolidated, hit it once more, and then rallied up. And then the next day at 9:30, so this is 4:14 p.m. on this candlestick right there. Now if I toggle one more over, now you're looking at this price, which is 9:30 in the morning on Tuesday, January 7th, 2025. We break lower, trade back up into that opening range gap, breaks lower, trades to the upper quadrant of the previous day's opening range gap. Then it goes to consequent encroachment, lower quadrant, and then a complete closure of the previous day's premium opening range gap.